other words, we are not done with stats. There's going to be another 25 minutes of slides, and I'm going to start where I picked off with the kind of notion of uncertainty. We are in a, I think, very tumultuous period right now in digital advertising. There is the cyclical change with the economy, but also the structural change, because signal loss, the move from the kind of web environment to the app environment, new channels coming on board, etc. What does this all mean? So I want to really outline what forces are shaping the market today and what that will mean for the future of our industry from a global perspective in the next years or so. And I brought kind of a drama in 5 acts, not a tragedy. We're going to look first at the economic space, right? How advertising relates to the economy, how macroeconomic trends impact, in particular, decisioning and budget allocation in digital. Then we're going to move into the marketers' minds a little bit, something that in particular for kind of seller-based organizations like the IABs is often something omitted. How is marketers' thinking changing? And then we're going to flip sides and think about what does that actually mean for media owners? What do media owners need to offer in the future to cater to these advertiser demands? Once we've done that, we're going to dive a little bit into AI and other future trends around programmatic to see how does the piping change that actually connects buyers and sellers in the future, and what new vectors of growth would this open up for digital advertising. So, without further ado, let's move into the first act, and it is ominously called Looney Tunes in the Polycrisis, which I'm going to reveal in a second. We start with the polycrisis, a meaty concept that was introduced by the economic historian Adam Tooze. It looks something like this. We're already at version 4.0 of this chart since the beginning of the pandemic. The polycrisis is quite different from other crises we've seen so far, the Lehman crisis, etc., in the sense that there isn't really a core, there isn't a central, there isn't really one causal factor. But as you can see here, the different crises, micro, meso, and macro crisis, which co-constitute and augment each other, creating a picture of uncertainty and unpredictability. There's some precursor crisis, today's situation, that drive potential outcomes in the future. And marketers, of course, love certainty. Marketing budget allocation is based on a perspective of what would happen in the future. Now, we don't just have signal loss in our industry, but we actually have a macro signal loss in the sense that it's very hard to interpret what's going to happen with the economy in the future. So we've seen a lot of short-termism being introduced in digital advertising. And one thing that I like to look at is beyond the typical kind of macro indicators like GDP, etc., which only come out every quarter or sometimes only every 6 months, is something like this here. This is the Economic Policy Uncertainty Index, where some economists got together and said, we need, in a sense, an alternative pulse on the economic world. Not so much is the economy going to grow or not, but is there actually agreement on the future trajectory of the economy? This is what this index measures here. So it looks at government statements, it looks at press releases, it looks at what journalists are writing, etc., what the World Economic Forum is saying, and it measures, do people actually agree, do experts agree, or do they not agree on where things are going? And you can see certain peaks here in this index characterizing major times in recent world history. We are still in a kind of elevated uncertainty index right now. The Trump election hasn't pushed this up remarkably, the second one, in contrast to the first one, but we're still in a heightened environment here, I think, which really illustrates this lingering polycrisis that we can't seem to get rid of. With this heightened uncertainty also comes a risk that the global economy is not going to chug along as nicely as we've seen right now in capital markets. And economists actually have a very complicated term for that, and that is the Wile E. Coyote moment. Here we are with Looney Tunes. It's a real term. If you look at the Financial Times, etc., there's so many FTC officials speaking about a looming Wile E. Coyote moment, which I think since 2020 has seen more and more press mentions. Why Wile E. Coyote? Of course, it has to do with the notion of gravity, right? The economy is chugging along, but we all know this little furry animal here. Only once it realizes it is in the air, not on solid ground anymore, this gravity sets in. And many are saying, well, the global economy is in a sense like Mr. Coyote here, that we are at the risk of realizing that we have lost all kind of traction and that gravity is going to pull us down. So that is the risk. And this is something that many of you worry about because we've seen historically that advertising budgets are being amplified by economic growth. When the economy grows a little, advertising grows a little more. If the economy is kind of static, advertising moves into panic mode and collapses. But should we really worry about this in our digital industry? The answer is not too much. And I'm going to show you this in two charts. On the left here, we have a correlation between real GDP and traditional ad spend globally. Each dot here is a year. We don't need to understand statistics, we just have to look at this value here of 0.8. 1 is the maximum value, so 0.8 is pretty strong. There's a strong correlation here between real GDP and traditional ad spend. The same chart behind you see on the right side as well, where here we have total ad spend in here. With digital, which globally is around 65% of all paid media ad spend right now. What can you see? This value of 0.8 has been reduced to 0.44, meaning the introduction of digital advertising in this mix means that the correlation between economic growth and ad investment is actually weakening. How can that be the case? Well, first of all, we have a very different set of advertisers in digital, lots of SMEs, and also we can see, and I'm coming to that in a second, a much stronger integration now of advertising and actual top and bottom line business growth. And what we find actually more links up with the growth in digital advertising is something like this. This is an example from the UK, which is the company birth-death ratio. Quite a morbid concept, but it really just looks at in what times in history are there more companies being started than companies being shut, and the other way around. And we can see that advertising budgets correlate with that ratio, meaning the level of competition or the intensity of competition for the consumer, regardless of underlying kind of macro growth, is a better predictor for digital advertising growth than the typical GDP, inflation, etc., other factors. And this also applies to markets. So markets that are more competitive, where you have more upstarts, where there's also more kind of more oligopolistic structures where companies challenge each other to get share of the mind and the wallet of consumers. They're typically more resilient in recessionary periods than other markets. This has been in the last few years a roller coaster. Look at this valley of death in here, and we can really see this being reflected in ad spend. This is a European perspective, but I think it illustrates globally how many ups and downs, hot and cold showers we've had in digital advertising since, in a sense, the last normal quarter, the last pre-pandemic quarter, Q1 2020. So let's quickly walk through this roller coaster a little bit. So after the last normal quarter with the pandemic that hit, panic, frozen budgets. We quickly moved into a crisis budgeting mode where people are focusing on a kind of short-termism, test and learn, measure and see kind of how consumers react to advertising. Suddenly, we moved into a fear of digital utopia where we thought we were going to live in the Zoom economy, ordering stuff online perpetually, and we saw a massive overinvestment in digital advertising. This was a bonanza we hadn't seen since after the financial crisis in 2008 and 2009. Suddenly, reality set in. The digital endemics collapsed based on cheap VC money, realized they couldn't grow sustainable business just on advertising. War was on the horizon, and of course also the level of competitiveness among companies was weakened as we saw companies were going bust. They couldn't really survive after the COVID bonanza anymore. A couple of limbo quarters right here, and suddenly we are moving into this territory here, which continues in 2024. This is an improved macro outlook and a must-growth strategy for many advertisers who are thinking, we actually must continue to invest. We must explain to consumers why we've done price increases. We must protect our brands. We must really continue with advertising. But how they advertise and how the logic where they allocate advertising is changing. That is something that is of crucial importance to us in this room today, and that forms the second act in my presentation. Changing marketer priorities fundamentally change media investment. Here you have a chart from PwC behind me. We don't need to go into the details here. It is a chart on top line and bottom line growth for consumer packaged good companies. Green is good, red is bad, that's it, and we move from the top line revenue down to costs at the bottom here. So the last period of really strong growth for consumer packaged good industries which invest a lot in advertising, maybe 20% of the total revenue, for instance, was kind of really in the Goldilocks era of up to 2019. They're all now suffering near and midterm lower growth and higher costs, which means these companies need to become more efficient. They're investing to become much more efficient a lot into digitization overall, not just in marketing digitization, but in digitization of their overall processes. That's creating fuel for marketing, but it's also changing who marketing in the organization is responsible for. So recently, Unilever said, we're not going to have a CMO anymore. That didn't mean that they stopped caring about marketing, but they changed where they attach marketing to. Not in the silo of its own metrics detached from the business, but actually they wanted to link marketing and sales to actually let the CMO world speak to the CFO world and the wider C-suite. And this connection here, marketing and business outcomes, is something that is fundamentally changing media investments. And we can see this here. So of course we're in the age of AI, so we said, let's train a large language model to go through the top 1,000 advertisers worldwide, trawl through their earnings calls, and see what narratives are actually surfacing here. I'm using CPG companies just because they talk a lot about marketing. Here are 8 examples. But the themes, the patterns you see here, they are visible nearly everywhere in these earnings call transcripts. And this, in a sense, forms the foundation for this new advertising logic I was speaking about. The first thing to note is that branding and digital, they used to be like fire and water a couple of years ago. They're coming together. And the second thing is, despite signal loss, etc., importance of data and targeting is increasing, in particular in combination with business outcomes, not marketing, but business outcomes, and then AI being used as an efficiency driver and also as an interpreter to connect all of this. Which in consequence means, globally, marketers are spending a lot of money. Some media owners are not seeing that. But if you're not seeing that, it doesn't mean the budgets don't exist. You're probably in the wrong market or selling the wrong thing. We're seeing it here in H1 data. Some is Q2 data because not everybody is producing updates in the same time. We can see here the marketing growth of large marketers, and then we have the average revenue growth on the dotted line here, meaning the growth in marketing is higher than the growth in revenue. This is something we predict is going to continue in the next couple of years. So this is a hugely important pool of opportunity that sellers of media can capitalize on. But the question is, are they really doing that properly? Because there's a changing guard of marketers. I looked at Ad Age, the quintessential industry publication, and did a bit of a time travel here. I looked at what were the top 25 marketers in 2022, and how did they look like 20 years ago in 2002. On the list here, everyone who is in light blue wasn't in the top rankings in 20 years ago. And if you look at the names here, these are either marketers that didn't exist 20 years ago, or companies that moved from the bottom of the ranks to the top. And many of these marketers don't have this historically grown symbiotic relationship between mass media and mass brands, which really characterized the 20th century and the advent of commercial television. So they're thinking about marketing quite differently. And they have to as well, because suddenly they're accountable to others. Marketing used to be a silo. But right now we're seeing that more and more digital marketing is actually integrated in these transformation activities I mentioned, which are manifest here in the cloud. So increasingly marketing moves into the corporate cloud environments, which in a sense creates for us here in the room, in a sense, an API into the brain cells of advertisers, right? Marketing and cloud are coming together, which means the marketing world has more say over the business, and directly business goals are funneled into marketing. And we think this creates some kind of flywheel that is going to drive digital investment in the future. But we have to think about how can media owners actually capitalize on this? It's not so easy. First of all, digital media outperformance has been slowing. On this chart here, we can see on the x-axis the number of years, and then we can see the share of digital share of total paid media budgets globally here. And then on the y-axis, we can see by how many percentage points did digital advertising grow faster than traditional advertising. Of course, in the first period here, it exploded. We saw a period of kind of relative stability here with little ups and downs as social and video proliferated, etc. A huge boost here during the pandemic, but now it's slowing down. So the question is, when digital is already so large, 65% of all budgets, we are entering this John Travolta moment. Where are those incremental budgets? Where are those elusive dollars? Where should they be coming from? Is it relabeling trade marketing as retail media, or is there more than accounting tricks to actually grow this? I think it really means we need to tap into what marketers want from advertising, which isn't clicks, views, and likes, and it isn't eyeballs. It's something else. And traditional media owners have not been very good, despite best efforts, to capitalize on this. Here we can see new acronym TMO, traditional media owners, in different markets, what percentage of their overall ad revenue actually comes from digital. We can see this here. This is a sizable percentage. But of course, the cost of this digital transformation is huge, and the linear core business is often eroding as well. So this growth in digital and this strong position in digital isn't really enough to keep the business really viable. Something needs to happen. And we can also see a decoupling of editorial environments and media investments. Here I split the global advertising market into two. This is all media. First, we have content media, which I very loosely count as editorial media, editorial first media. Television, newspapers, magazine brands, I'm even putting radio in here, and also cinema. And you can see globally, that spend, despite this momentum that I showed you earlier on the advertiser side, this is actually static. More and more spend goes into other channels, which in particular are very signal rich and are close to the consumer transaction to deliver those elusive outcomes. This is where money is going. So we need, in particular, traditional media owners, think about what they're selling in the future and build bridges to the world of the light blue. And we can see this, I think, well structured here on this slide. More and more budgets are moving. This is global ad budgets, a 900 billion market currently, moving into performance budgets. Those that allow creative optimization, that allow performance measurement, targeting, closed feedback loops, etc. And the open web that many of us are active in is actually only roughly 6% of global share, which also means that around 6% of marketers' mind share, which also suggests why they're not leaning into the signal changes we're discussing so much in our part of the industry more actively. But traditional media owners have a problem. They're selling audiences, but clients want outcomes. Outcomes can be what you see behind me, but it doesn't need to be app install or really some really crude or very performance-oriented outcomes. There's a difference between performance and outcomes. It can just be a way of measuring the impact on top or bottom line business growth. But this is where we have to go, where traditional media owners have to go. Otherwise, something will happen, like the CEO of one of US's largest publishing groups, Dr. Meredith, says pretty bluntly, if you can't show performance, replace it with outcomes here, you're dead. So even editorial media need to show some kind of outcomes. And we can see where growth is happening globally. Here's the compound annual, the average growth rate for different media channels globally up to 2026. We see retail media and CTV are thriving. Interestingly, retail media includes Amazon as well. This is something close to the consumer transaction. And CTV, of course, is an awareness channel, but fueled often with data that allows you to link it back to transactions or some other metrics. And increasingly, these two are not separate, but together. Think of Walmart's acquisition of Vizio. So we're seeing more and more kind of relations emerge between the retail world and the CTV world, bottom of the funnel and top of the funnel. And marketers are now actually starting to shift budgets away from traditional media and the open web to those environments. Here's a study that we did in Europe on where are budgets actually coming from in the retail media space if we remove trade budgets. Linear TV, traditional ad channels, but also programmatic advertising in the world of signal loss. This has sparked quite a few remarkable headlines. Maybe you've seen those in Australia as well. Something like this: retail media is going to be bigger than TV. Why TV? Because TV, of course, is the gorilla in the room. It is and remains kind of the ultimate advertising medium, in particular for CPGs. So comparing retail media to CTV is often designed to show the real potential of this new set of channels. But is this really true? Now, let's look at the German data, my home market, where I was able to do a little bit of an archaeology and go back to television ad spend since 1980. And we saw this inflection point in 87. Which is when cable TV came about, when the commercial broadcasters came about, and we were on a 14-year growth spree up until peak linear television. This is excluding BVOD, etc., in the year 2000. And we had a 14-year compound, in 14 years, a 13.2% compound annual growth rate in that time. And I split this into two. 7 years, we have 7 years of retail media data to build some comparison of nearly 20% growth rate. And this is all adjusted for inflation. Now, if we're layering over retail media, it's actually repeating exactly what television did back in the 80s. The growth rates, adjusted for inflation, are actually strikingly similar. So we're seeing a change of guards here that actually relates to these marketer-driven kind of outcome-based marketing. And the history of media, if we think about it, is really a history of bundling, unbundling, and rebundling. I think we're entering a new era, right? Before the IAB was founded, this was across content media, ads, audience, and commerce, how the old mass media model worked. We had static content on bundled media, cable channels, etc. Ads were on television. We had mass audiences, undifferentiated, 14 to 49, and we drove people to buy stuff in physical stores. The world of the 2000s, the kind of fragmentation era where the IABs emerged, is really a change of this. Fragmentation, social, more niche audiences, and also e-commerce was added in the mix. The future might be quite different. We don't really have a name for that. It could be the connection era. We don't know. And of course, one era doesn't replace the other. But there are new logics emerging across everything. Content increasingly algorithmic, media increasingly mimetic. Suddenly, or despite the crisis of the press and editorial media, the creator economy is booming from Substack to TikTok, etc. Audiences written to cultural trends, and commerce, even you can buy stuff directly on shoppable media, on TikTok, etc. So it's a different way of bundling things. And increasingly, when we look at distinct media channels, media owners need to reorchestrate them together across those lines here, not see retail and television or creators as distinct channels, but bring this together to deliver the outcomes that advertisers want. We can see some examples here, for instance. Now already you can buy Amazon stuff directly on TikTok. TikTok is great at discovery, Amazon isn't, but Amazon is great at sales. So this is why you have this combination, and increasingly, of course, creator partnerships as well. All of this, of course, means that we need to think about the infrastructure, the piping in our industry, how that's changing. And the programmatic world that many of us are in a weird kind of period of trying to preserve the past and to create a radically different future at the same time, sometimes even within the same company. So programmatic, let's look at the European data. We have kind of 13 programmatic first markets in our study. Programmatic first markets, markets that spend 50% or more of all budgets which could in principle be programmatic on programmatic media. So it has become kind of a de facto trading infrastructure. But it's of course changing a lot, and how the market is being defined varies as well. We recently had in the US the Google AdTech DOJ trial that many followed, and I think it was really a great metaphor actually for the Kafka's book of the same name, where there's a funny quote in there which goes like this: "The right understanding of any matter and a misunderstanding of the same matter do not wholly exclude each other." And we saw very different definitions of what is programmatic. Is a DSP and an SSP, are there separate instances in the value chain, or are they one thing, right? We in a sense have a confusion on what really is the programmatic market. Ad tech in this world, though, despite definition problems, is thriving. Here we can see our index, and our ad tech 14 index. So 14 listed ad tech companies. We're looking at how much are they growing, right? And we see continued double-digit growth, often higher than media owner revenue. This is crucial because these companies are starting to manage complexity. But despite the growth, is it all smooth sailing? We're seeing a complete change in how this market operates. If we go on the buy side, we can see that probably around 80% of open web demand is now being trafficked through 5 different companies. Remember, all of these companies have limitations in how many impression opportunities they can see, a queries per second limit, meaning that these companies are increasingly, I said as a neutral term, decisioning gatekeepers on where budgets go. So the signals they use to make decisions actually affect media owners a lot. To cut through this, there's the limited companies that have a limited amount of listening time actually, media owners said, you know what, we're going to do the exact opposite. We're going to go on the more the merrier approach, and they built many what we call thin pipes, i.e. distributing programmatic monetization across a vast amount of different SSPs. Here's one media owner, and you can see kind of the cumulative contribution that every different kind of SSP makes here. Just to, in a sense, be able to phone home, to listen, to be able for those 5 companies to listen to you. This isn't sustainable, it's a race to the bottom. The market is changing, but it's changing too slowly. Here we see the length of the ads text files for 20,000 publisher. On average, the publisher has 61 different SSP. Who, if I woke them up at night, could recite 61 SSPs? I couldn't, right? These are unique SSPs. But this is exactly not what we need in the world. In the world of first-party data, of having better signals, of driving outcomes, we need fewer but thicker pipes. This is where the industry has to go. And we have this huge problem that we speak about innovation a lot on panels, but we're actually quite a conservative industry. How often have we spoken about going away from the cookie? This is the reality. So I analyzed data from a large advertising agency, and I counted what are the different targeting types and what are kind of ID-based versus cookieless approaches. And you can see everything that we claim constitutes the future still is actually a small fraction of overall investment. This has to change. And we can also see ups and downs in the sandbox adoption, for instance, as a kind of proxy for privacy-enhancing technologies. Of course, there were 2 moments. One, when third-party cookie deprecation was delayed, companies were kind of going on the brakes. And then when it didn't happen, they actually completely stopped. And this is a huge problem, not just for the sandbox, but it's a problem of innovation, of trying to hold on to this old world of third-party cookies for as long as possible. I think this is something that we have to break through, in particular for the open web, to be able to attract those new advertiser budgets. The world is changing, and I think we can see kind of a new world of ad tech emerging. You can divide things into signal companies and media management execution companies. Signals, i.e. the ability to interpret, to drive decisions, is becoming increasingly important. We saw some of the sponsor companies today which are already doing that, either having single signals or aggregating signals, etc. And increasingly the combination of having a signal and making decisions on that basis and pushing that into activation, this is where the future value is. Activation itself is increasingly commoditized. Signals often can't be acted on, so those who control the decisioning layer will be the future kings of ad tech. And we can see a battle between DSPs with some signals, and then SSPs, in particular on curation, that are trying to be the kings of the hill and own decisioning. So that battle will be interesting to see how it pans out. Very quickly, to wrap up, where's growth going to be in the future? We can see here, this is Europe right now, the size of different media channels and their growth. And if we map over programmatic opportunities over a long-term horizon, we can see things are panning out like this. The world of programmatic 1.0, the banner world, is not growing anymore. We need to shift away. But I think there are huge opportunities in out-of-home, for instance, in audio with AI-driven creatives, in retail media programmatic, and also in the world of social. To wrap things up briefly, of course, the programmatic infrastructure isn't just about buying and selling and profane statistics, but it's increasingly about AI. And we've seen AI really gain a hold of this industry in a whole dramatic sense. If we compare what happened between the launch of ChatGPT-3 and GPT 3.4 in 3.5 months, the entire, in a sense, history of ups and downs of media has been recreated. End of media, text apocalypse, editorial media are dying, huge investment frenzy, etc., all of those things. But increasingly, I think a reality is setting in that we're still a long way from actually seeing the impacts of AI. We are, in a sense, in the kind of picks and shovels phase of AI. Here you can see the indexed stock performance, excluding NVIDIA, of different types of companies in the FT. So there are the hardware companies, software companies, and then the kind of business owners, the companies who use AI. This is the light blue line at the bottom, and we as an industry are in this light blue line. So we're still in this picks and shovels phase of AI, where it's about infrastructure, technology, hardware, and software, and we haven't really seen the productivity gains or the transformations that we had anticipated. Not adopted at scale yet. It's going to come over the next decade. We see some early adopters, but things are going to take far longer than we anticipated. But AI is now already an integral part of advertiser strategies. Going back to the earnings calls, we went to kind of the presentations of 4 different companies to see how they're using AI. It's already table stakes. Coca-Cola just put out an AI-based Christmas ads. They're using it for shopper, for creative. Pepsi using it to plan differently. Heinz looking at efficiencies, and Mondelez really focusing on AI-driven content. This is already there. And I see that many advertisers are more advanced with this than media owners or even intermediaries. The buying and selling is increasingly going to be AI-based as well, where, again, decisioning plus activation plus learning is impact. And for instance, those companies can do it quite well. If you look at the titles of the AI tools, I think Google really missed something by not calling PMax Plus. They're all pluses in there. But the important thing is, what we have to move into in ad tech as well, closed loop systems that control creative parameters, measurement, activation, and optimization. That's going to be the future. And we can see some saying, you know what, in this world, we don't need agencies. Everything is going to be an AI agent. Sam Altman very famously. But I don't really trust him because his prediction of when we're going to reach artificial general intelligence, they always veer between next month and in 10 years. So we can't really trust him. But some companies like Klarna, for instance, the payment provider, says, you know what, we don't care about those predictions, we just do it. And they say, we implemented AI and we cut agency costs and our marketing efficiency was going up dramatically. So does this mean the end of agencies and the end of the value chain as we know it? I don't think so. But we need to bear in mind there are more and more what we can call good enough advertisers who don't need to win a Cannes Lion, who really just want to drive some kind of efficiencies. So we have to reckon with this. But agency models need to be reinvented. There's a fantastic book by Michael Farmer with a bloody title, Madison Avenue Manslaughter. It's about fee-cutting clients and agencies in peril. And he's an accountant. So he transforms the entire creative process of an agency into a boring metric, the scope metric unit, measuring kind of the time it takes, time and cost to create a single output in the value chain from creating an ad to delivering it. And he sees that agencies are being paid less and less for every step in the value chain that they do. Create a downward spiral. So things have to be reinvented. The agency model has to be reinvented. And they look a lot at AI. We're going back to earnings calls, and here you can see how some of our favorite holdcos are speaking about AI. Right? Many different mentions of that, to try to reinvent the model, to move away from this kind of fee cutting, to kind of outsource things, to create a new value. And here's an example of some kind of a dissection of agency strategy, not an endorsement, but you can clearly see how they're trying to reposition themselves. It's not an agency anymore, it's a first intelligence system. And suddenly all these different data assets are coming together to emphasize scale and decisioning. Right? Every agency is trying to do that. And we have to move in this world if intermediaries like agencies want to create value. But, and I'm concluding with this, in this world of AI, we need to be, I think, quite mindful. And that is that we can easily see a race to the bottom, a dumbing down. And this quote really resonated with me a lot from this book, The Master Algorithm. People worry that computers will get too smart and take over the world. The real problem is they're too dumb, and they have already taken over the world. So human oversight, our own ingenuity will remain vital. And even if some jobs will be cut by AI, I think it will elevate all people in this room, in our companies, to do more strategic tasks that humans can do better than machines, and I think there's a lot of the human value and potential in our industry. And with that, thank you very much for bearing with me in these 5 acts, and maybe we have time for some questions.
Thank you so much. And the ability of your presentation is always amazing, but to do a jet lag is impressive. If anyone's presented with jet lag, it's hard. Not physically. Although, can I quickly ask one thing that you're really, really positive about next year? Positive about Daniel. What excites you about next calendar year? The one big thing.
There are too many to choose from. But I think one thing that really excites me is that collaboration is moving from a buzzword to a real mandate that companies are seeing. They realize we need to build scale, and we need to collaborate across media owners with different data sources to build a new ecosystem. And I think we are in the builder phase of that. We had it once in 2012. It didn't really work out with publisher alliances, et cetera. But I think we are in the 2.0 world of that, and that makes me quite excited.
Awesome. Spoken like a true IAB spokesperson. Thank you so much. Another round of applause.